Mike, would you like to do the original introduction?
Yes, I will. I'd be happy to do that. So welcome, everybody. Thank you again for joining us for our year-end tax planning webinar, facilitated by me as your host, but really all of the substance is going to be put on by our friends at Donnelly-Boland. If you've attended our prior sessions with them, you know that their content is really high quality. And I'm very pleased to have Kevin Boland, who is the principal at Donnelly-Boland Group, a business consulting group, accounting services, bookkeeping. They provide a wide variety of consulting and business services to small businesses in the Pittsburgh area and all throughout the Commonwealth of Pennsylvania and other places. I know Kevin used to fly to, was it Guam or was it
American Samoa?
American Samoa, right? So, you know, if you have any folks out in businesses in American Samoa, Kevin will take care of them. But anyway, I've been doing business with and been friends with and a partner with Kevin Boland for many, many years. And he is really just a really good business advisor. And you're very, very lucky to have him on the webinar today. I know we love Noel, but we've got Kevin today, and so that's a treat. So with that, I am going to hand it over to Kevin.
Well, let me just do a couple real quick things. That was the meat and potatoes. I get the little small things. I'm going to be making Kevin the host today, and he's going to be leading us through. But we also have Linda Lemaster and Ray Tokar on the call today too. And really, we want to kind of a collaborative approach. If you have issues and you have questions and things, you know, you want to learn a little bit more about them, there's a Q&A pod. You can actually type in that while it's going on. Ray has helped facilitate this a number of other times before. He and Linda would be able to answer some of those, or sometimes they might stop Kevin and say, hey, Kevin, check out this question and answer this for everybody. Also, if you have regular things that you just want to bring up, little quick anecdotes, that's where the chat pod is. So at the bottom, there are two different places for you to talk about things. If you have a very specific question, put it in the question and answer. If you have something that you just want to bring up and maybe talk about or say like, I had that same problem too, that's great. We would encourage you to put that in the chat pod. So I am going to make Kevin the host, and he is going to take us off today, and he is going to share his screen, and he has a lot of really good information, and we're looking forward to today's presentation. KB?
So the first poll question.
There it is.
Give people a few minutes to answer that question.
Everybody who answers 5 million or more, please call me immediately after the session.
So then right there, you can just hit stop poll and then share poll, and then you can share the results with everybody. Yep.
So it looks like the estate exemption could drop all the way to $1 million, and our group would not be overly concerned about it. And that's probably a good thing. But with that, I'll go to the first slide.
And I think what by exemption, what Kevin is referring to, I believe, is the estate tax exemption, the amount of your estate you can pass without having to pay federal state tax, right?
It is. And the good news is, while there was a lot of discussion about that, and the consultants came out of the woodwork to encourage you to look at your estate plan, and unbelievably, that is the one thing that they did not change at all this year. And it looks like it may be off the table for a while longer yet. So the last bullet on our agenda, you can see, has been crossed off because there's nothing to talk about. So the estate tax exemption has stayed where it's at. The personal tax savings opportunities are the first things I'd like to cover, because those are the things that hit each of us in the pocket the hardest. And then prospective changes for 2022, some business tax savings opportunities after that. And then the infrastructure bill, the impact it had on taxes, there are a couple provisions in there, but most of the changes are still prospective. They're in the Build Back Better bill that is currently being debated and has not yet been passed. So at this point, We don't have anything definitive in terms of 2022, but there is some promise that that will be voted on before the end of the year. I'm not sure that that's a promise or a threat, but there is a discussion that that will occur before the end of the year. So in terms of personal savings opportunities, a lot of these are going to seem very similar. You've heard them in the past. In some respects, they don't change. There are orderings to these in terms of which ones are more tax efficient. And, I'll share a little vignette later from a professor that does research on this sort of thing. And he can produce all the math that you want that shows you why you should do things a certain way. But at or close to the top of the list is contributing to your retirement savings accounts. And that's one of the few hindsight opportunities that you still have. You have the opportunity to contribute to an IRA or a SEP or a KEO until April 15th in the case of IRAs or spousal IRAs, and until the extended due date of your return in the case of SEPs and KEOs. The IRAs and spousal IRAs will allow you to put away $6,000 for you and your spouse. If you're over 50, that rises to $7,000. Again, if your spouse is over 50 as well, $7,000 for them. SEPs and KEOs are limited to the lesser of $58,000 or 25% of your net earnings from self-employment. So there's a chance, again, to assess your tax situation after December 31st. Once you've had the numbers in the return, look at things and then make a decision as to whether or not you want to fund an IRA, a spousal IRA, your SEP plan, or your KEO plan.
Kevin, can I ask a quick question on both of these?
Sure.
Can you start the IRA after December 31st and contribute to it? Or do you have to have an existing IRA plan or SEP plan that exists prior to the end of the year?
I think that you can open an IRA after January 1st. Just have to have it done by the due date of the return, but you got to have it funded too. So
Sure.
you walk in on April 15th and expect to get it done, it's not going to happen.
Right.
So there is a little bit of pre-planning, but you don't necessarily have to have it done by December 31st.
How about the SEP or the KEO? Can you start that after December 31st? And then
SEP is a
and
form
fund
of an IRA, so I believe you can with that as well. And I'll defer to Linda to correct me if I'm wrong. I'm not the routine tax person. That's Linda. I'm the business owner that understands taxes because it's been painful when I haven't. So.
Somebody did ask a question on the contribution that's per person. Is that right? For IRAs.
Yes, it is.
Yeah, that's per
Personal.
IRA. Each person's going to have their own IRA. So thanks.
Yep. The next opportunity, and in some cases, this might be a better opportunity, is to contribute to HSA plans, health savings account plans, if you have a high deductible health insurance plan. First, because it's portable, and second, because if you use it for healthcare, it escapes tax altogether, unlike a regular IRA or a SEP or a KEO, where you defer the taxes and are taxed on them when they come out of the arrangement. So an HSA, if you use it for medical benefits, is actually preferable in some cases to funding your retirement plan. Your limits here are $3,600 if you're in a single plan arrangement, $7,200 if you're married filing jointly, and the HSA covers both parties in the tax return. Third option I mentioned here is contributing to a tax advantage Section 125 plan if it's offered by your employer for health care and dependent care. The downside to this is it's use or lose. You have a year to get the money spent, so you want to make sure that if you set money aside through tax deferral into a Section 125 plan, that you're going to be able to use it. Dependent care limit is $5,000. If you have a child in daycare for the full year, it's unlikely that you wouldn't be tapped for at least that much. Healthcare limit is $2,650. That's less likely that you'll hit that depending on how healthy you are. If you're somebody that routinely has dental care, eyeglasses, hearing aids, chances are you're going to hit it, and it may make sense to take advantage of this. You'll get the deduction on a pre-tax basis from your pay less and Social Security taxes and some other things, and end up ahead of the game if you participate in these kinds of plans. The problem is you typically have to front end the cash. So when you actually see a service provider.
know whenever I had kids in daycare, I used the dependent care limit all the time, every year, fully. It's a big benefit.
Going to the next page, contribute to 529 savings plans. Those are for private education or higher education. The good news with this particular savings arrangement is it avoids federal tax on the earnings altogether if it's used for education. Second benefit is that it is tax deductible for Pennsylvania state taxes, maybe tax deductible for other states as well. You'd have to check with the state that you're resident in. The downside of this in terms of a savings benefit is there is no deduction on the federal level. Your federal benefit is that the earnings on the plan escape tax altogether if the plan is used to fund higher education for yourself or a dependent. The next savings opportunity is charitable deductions. This was introduced last year as a pandemic relief proposal and provided for $300 in deductions for non-itemizers on a joint basis. That's going to rise to $600 for 2021. So the first $600 of charitable deductions, if you're a non-itemizer, will be deductible. Those are cash deductions, clothing donations and property donations to the Salvation Army, Goodwill, the vets, or any other organization don't count. It needs to be cash or monetary contribution through your credit card or some other payment mechanism.
Kevin, could I ask another question on these? Are these contributions that can occur after January 1, but before April 15th, or are these ones that you have to do before December 31st?
Yes, this is not a hindsight planning opportunity. Those are, like I said, extremely limited. You got to get it in before 12/31.
Okay.
If you're contributing something like property, and that goes to if you're itemizing, generally the people you're contributing it to are going to need some lead time as well. So, for example, if you were giving money to the Pittsburgh Foundation, they have a schedule as to when you have to get it in by for them to give you credit for 2021 taxes.
Okay.
That kicks us into the next slide, which is itemizing deductions. The threshold amount for that is $12,550 for singles and $25,100 for married filing jointly. And our experience has been that very few people itemize anymore. It used to be that 80 or 90% of our tax base itemized. In more recent years, it's been closer to 10 or 20%. And the situations where you see it are people that are very philanthropic or very sick. Your state and local taxes, which were a principal reason that most people hit the itemization threshold in the past, were capped at $10,000 during the Trump presidency. So you needed, if you were married filing jointly, to find another $15,000 in deductions from mortgage interest. Unless you have a huge mortgage and a huge house, you're probably not getting there. So that left contributions and medical expenses, and medical expenses were only deductible after they went over 7.5% of your adjusted gross income. So again, most people were not itemizing. Now there is talk in the new tax act of raising that cap on state and local taxes, which may change the dynamic. Otherwise, if you're very philanthropic, you can take charitable deductions now up to 100% of AGI. That's up from 60%. That's a measure of relief this year. And if you're gifting appreciated stock, that's limited to 30% of your adjusted gross, but you can carry the excess forward to future years for deduction purposes. If you elect to make a contribution using one of your IRAs through your required minimum distributions, that lowers your income and it may favorably impact medical deduction thresholds and a variety of other things that are tax advantageous. So you may want to consult your tax advisor in terms of looking at that as an opportunity to save some money. With respect to the medical deduction, if you are responsible for elderly relatives, I can't stress enough how important it is to take a good hard look at this and get ahead of the curve. If you have a relative in an assisted living facility, the chances are very good that you will be able to itemize deductions, because a significant portion of your loved one's room bill, generally a third or more, will be eligible for the medical deduction. And the facility will generally tell you how much is being spent on nursing care relative to the resident. And so knowing that, then it's important to get a handle on what other medical spending they have, whether it's Medigap policies, their Medicare Part B coverage, any prescriptions, any PCPs, medical, dental, health, vision, find out who their providers are and make arrangements to get year-end statements. That's a huge opportunity to save some money for folks that are on a fixed income and have some money available to do some things that improve the quality of their care or the quality of their life. So that's a personal aside, having had to address that for a number of elderly relatives recently. The tax savings there can be significant, and they are likely to be itemizers. One of the bad news items is that there's no exclusion for unemployment income this year. So if you were unfortunate enough to be unemployed and were paid unemployment income, you will be taxed on that this year. That can be fairly significant. I know that last year they changed it in the middle of tax season. No guarantee they won't do something like that again, but at this point it is taxable. Stimulus payments, would say know the breakpoints. If you're single, it's 75,000. Married filing jointly, it's 150. Head of household, it's 112,500. And I would say the opportunity here is if you have dependents that are in college or about to graduate, it may make sense for you to look at the break even. You get a $500 credit for another dependent, but if they're not on your tax return, they had a $500 and a $600 stimulus payment associated with them last year, and that jumped to $1,200 on the first payment that they would have been eligible for. And this year, in the April payment, it's $1,400. So if you're feeling like your young one can benefit from a little bit of extra cash starting out, you may be better off foregoing the dependent credit and allowing them to collect the stimulus. If they didn't get it in the ordinary run of things, they would get it in the course of settling their tax return. And that would provide them a little bit of extra spending money as they get started. Harvesting tax losses in your investment accounts. If you get a realized gain or loss report from your broker and look things over, if there's positions you're not wedded to, or you have some significant losses there, it's a way to get rid of some of your gains or other investment income by cashing those in before the end of the year, harvesting the loss. If you really like the stock, wait 35 or 40 days, comfortably past the 30-day limit for wash sales, and then you could certainly buy it back. And then lastly, consider tax advantaged investments. Mutual bonds, insurance products are two options for shielding some of your income from tax. So with that, I want to switch to our second poll question. Well, first, I guess I should share the results of the first one. I'll give that quickly. Go to my second poll question. And with that, share the results of that. And it's like we're all over the place on this one, and fairly even distribution between higher, lower, and relatively the same. Under those circumstances, I'll alert you to the fact that you do have one final estimated payment opportunity coming up in mid-January of 2022. And that's an opportunity to get sufficient amounts paid in so that you don't have a tax surprise at April 15th or put yourself in a situation of facing penalties for underpayment of taxes. So if you're looking at where you were relative to 2019, If you're about the same, look about where your tax bill was for 2019 and figure out how much you have paid in and how close you are to that number for this year. Likewise, if you're higher, adjust upward. If you're lower, adjust downward. If you have a CPA or other preparer doing your return that has planning software, you could ask them to run a 2021 scenario for you and get an idea of whether or not you ought to make an additional contribution. Oh, too far. Last round of personal savings opportunities that are out there, which will be available to some. Claim your available credits. Retirement savings credit is available up to a max of 50% of your contribution at lower income levels, and it scales down from there. For younger participants who are just starting out, especially June graduates that have only a half year in, making this contribution can certainly save you some tax dollars. Putting it in a Roth can set you up to save tax dollars even farther down the road. Earned income credit is available with no children. It maxes out at $1,502. With 3 or more children, it maxes out at $6,728. That's limited on an income basis, and the limits are fairly low, so a lot of folks will not qualify for that. Child tax credits, there's a higher amount. It's fully refundable, covers children up to 17 or 17 years and younger. And in a lot of cases, the IRS has advanced the portion of that credit for the last half of this year unless you opted out. So if you've been getting checks from the IRS or getting money for your child care credit, then you're aware of what I mean, but that'll be settled much the same way the stimulus credits were as an advance as part of your return credit. The other dependent credit is available up to $500. There are also an assortment of education credits. There are energy tax credits, which are expiring over the next 3 years. So you might want to look at what's expiring and what you need done around your house to take advantage of those before they disappear. And then foreign tax credits, if you have an investment portfolio or investing in overseas mutual funds or stocks, there may be foreign tax credits available to you for taxes paid on the withholdings of those investments. So some prospective changes for 2022 in terms of planning. So we'll start with the good news, the things that are temporarily off the table. The increase in the top income tax bracket from 37% to 39.6%. That was certainly good news to those that are in that top bracket, and is kind of surprising given the rhetoric around the campaign and afterwards about who needs to be taxed more. There's also off the table is the increase in the top capital gains tax rate to 25%. And an implementation nightmare was also scratched, the billionaire wealth tax, which would have required tax to be paid on changes in the market value of investments that were not sold, but were just carried in inventory of the investor.
I, for one, say thank God for me personally that the billionaire wealth tax did not go through. I mean, I can't tell you how relieved I am.
Well, and you should be, Mike, because while it's intended for billionaires initially, we know eventually it would find its way all the way down to those making 100,000 or more. And at that point, it starts to hit everybody that is in a two-wage earner family. They also didn't change the estate tax exemption, which was good news. They didn't, more importantly, change the step up in basis rules relative to assets passing through an estate. That's an option that allows you to revalue the assets in the estate to the value that was reported on the inheritance tax return and calculate any future gain or loss using that number, which is typically much higher than the original acquisition cost of the decedent. So it allows the beneficiary to avoid significant capital gains tax when they ultimately do sell those assets. And then there were also no changes in the carried interest rules for those that are investing in startup companies. So next, talk about prospective changes for 2022 that are included in the current version of the Build Back Better bill. So this is not passed yet. It's under discussion. I guess in terms of getting the infrastructure bill passed, they needed to commit that they would allow this to come to a vote. So I should expect that between now and December 31st, there will be action on this bill. That's not to say that all of these provisions will survive in it, but they are certainly on the table. And unless they're negotiated out, we will see some form of these. The first item is actually good news, and Mike will share about this. It's raising the cap on the state and local tax deductions through 2030, retroactive to 1/1/21. And they would raise the cap of $10,000 on state and local taxes to $80,000. That will substantially increase the number of itemized filers that are out there if it passes. This will certainly benefit a lot of Pennsylvania residents, but will also benefit some of the particularly high tax states on the real estate tax front, New York, California, any place where real estate taxes are a significant component because of housing values.
Yeah, that was a particularly sore change the last time around. So I'm glad to see that may be coming back.
Yeah. And it's somewhat ironic, again, given the rhetoric around the campaign that the target is to get the wealthy to pay more taxes. This is not going to benefit your lower income taxpayer, but it certainly will benefit a lot of your middle and higher income taxpayers. It also made permanent the active pass-through loss limitation enacted in the Trump Tax Act, the Tax Cut and Jobs Act. And that limits the use of excess business losses to offset non-business income. So that's not really an adverse change. It just makes something that we're dealing with now permanent. So there's no future opportunity when that disappears, but we've been living with it to this point, so it doesn't change things for the worse. The next one is going to be painful for anybody that's a small business owner involved with an S Corp, an LLC, or a partnership. And the National Federation of Independent Business, which is an advocacy group for that sector, estimates that 75% of its membership falls into that category. It will extend the net investment income tax of 3.8% to all business income. Currently, that net investment income tax applies to interest, dividends, capital gains and losses, and rents, essentially any passive income. But now it's going to extend it to all earned income. So if you're an S Corp in the legal profession, the medical profession, the accounting profession, construction trades, or anything else, any pass-through income from the S Corp is going to be subject to this 3.8% net investment income tax. So it will not escape that, and that will be an additional hit that you'll be taking. Coupled with that, the small business deduction, which gives us a deduction for 20% of those earnings, is going to expire in 2025. They've made no attempt to keep that permanent. So if this passes in 2025, you'll see a second hit as another 20% will be subject to that 3.8%, or you'll fail to get the benefit of that deduction going forward. Now, in a nod to dealing with the higher net income folks, there will be a surcharge on high income individuals, trusts, and estates. So in the case where you are making over $5 million in modified adjusted gross income, your tax rate is going to go up another 5%. And if you're fortunate enough to be making over 25 million, it's going to be 3% more than that, or 8% in total. So that top tax bracket of 37% would then become 45% over 25 million, or 42% if you're over 5 million. The good news is you're making a lot of money. The bad news is the government's going to take more of it. For trusts, that 5% kicks in at 200,000 modified adjusted gross income, and the 3% additional surcharge kicks in at 500,000 modified adjusted gross income. So if you have trusts that are paying tax at the trust level, that's going to hurt, and certainly it will probably prompt those trusts to push more of that income out to beneficiaries so that it's taxed the next level down, or to take other steps to minimize that tax because it's set at a fairly low level on the trust side. I'm not sure if Mike has anything to interject there. I know that there's probably some legal strategies to plan for in those particular cases to shift the income to where it's taxed less.
Yes, yeah, I would. I mean, anybody that's dealing with the trust like that should definitely have legal counsel, involved, especially at those levels.
Okay. The other prospective changes include extending the green energy credits, specifically for electric vehicles. There's some significant credits out there. So in the continuing push to get away from a carbon-based economy, there is an incentive to use green energy and to convert to vehicles that are driven by electricity rather than fossil fuels. Retirement contribution limits are also being considered. This will limit contributions to accounts with balances that are over 10 million. So if you're one of those fortunate folks that's amassed 10 million or more in your retirement plan account, know that you will no longer be able to contribute once you're over that level. And it's also going to increase the required minimum distributions for those accounts. So you won't get the benefit of saving more, and you will be required to take more out so that you can be taxed on it. All of this is going to drive taxes higher on a select group of high income individuals. On the plus side, earned income and expanded child tax credits have been extended through 2022. So there is a nod to those that are in the lower income brackets and those that have children to take care of in their formative years.
Yeah, I would only make one sort of somewhat related comment on contributions to retirement accounts, especially IRAs. With the advent of the Secure Act, folks should be thinking about whether they want to accumulate a lot of money in these tax deferred plans because of how quickly it has to come out after they pass away. They should be thinking about the impact of that, and maybe they'll want to make some different choices about investment strategies if they want to try to control their beneficiaries' access to their wealth after death. For some families, having all that money come out in 10 years or less could be not very desirable in some family situations. So a lot of people don't really think about that. The conventional wisdom has always been sock as much money away as you can in these tax deferred plans. But because of the Secure Act, that conventional wisdom is really being challenged. And a lot of folks maybe would want to convert assets to Roth or to make some other choices on a going forward basis.
Very good point. Interestingly, the wash sale rules have been expanded to include cryptocurrencies, commodities, and foreign currencies, and they've been extended to related parties, which is another likely reporting nightmare, and makes me wonder if some of the folks that are passing legislation like this give any thought to the nightmare they're creating from a reporting perspective. But essentially, if I sell something at a loss and a relative of mine buys it within 30 days, then I'm going to be in a position where I've had a wash sale. I'm not even sure how you track that, but it'll be interesting to see what develops there. I think certainly they can impose more reporting requirements on brokers and the like, but it is going to be a challenge to consider that for individuals and tax preparers alike, especially since you may have no control over the person that's creating a wash sale for you. And then lastly, there will be some changes to the worthless securities rules. If they were involved a business loss, some of those losses would have been considered ordinary income, offsettable against ordinary income. Now they're going to be considered capital losses, and they're going to have to be applied against capital gains first and deferred until future years when capital gains materialize, if they're significant enough, before you get the benefit of those losses in terms of cash flow from your tax returns. So with that, I want to take just a quick break and go to our third polling question. So at this point, it looks like our participants, for the most part, have returned to pre-pandemic levels and are about where they were in 2019.
I suppose that could be good news or it could be bad news.
Well, on balance, it beats the alternative of much worse.
Yeah,
I mean, if you're fortunate enough to have done better during this pandemic, good for you, and certainly for weathering the storm.
yeah.
There are some business tax savings opportunities out there, and I specifically say 401k plans for here because this is again a hindsight planning opportunity for the business owner. 401k plans by their nature are non-discriminatory. So contributions of a discretionary nature are going to benefit all employees. They don't go solely to the owner. And 401k plans for the individual are really not something you can adjust in November or December of the year. Usually you have to do that during your open enrollment periods. And once you lock in, you're locked in unless you opt out for a hardship or some other reason. But business owners, to the extent that their plans provide for discretionary contributions, can make contributions to the plan up to the extended due dates of their return. So in the case of a C Corp, that would be October. In the case of an S Corp, it would be September 15th. So there are opportunities to put aside additional funds and save taxes, and in a lot of cases benefit the owner. So the owner can contribute up to $58,000 of deferrals and discretionary contributions to the 401k plan on their own behalf. It can go to $64,500 if they're over 50. And next year, those amounts rise by $3,000 more in each case. So there are opportunities on the business tax front to use the 401k plan to put more money in the owner's pockets and save some taxes in the process. An additional idea, which is starting to get traction, especially with small employers that have a lucrative business, or cash balance pension plans. This is an opportunity to calculate a defined benefit, if you will, determine the amount necessary to fund it, and then commit to funding it for a defined period of time. So that's the kicker. You need to be able, once you adopt the plan, to contribute to it for a period of years. And having made that commitment and following through on it, you're then in a position to terminate the plan, distribute the assets to other qualified plans, and in the meantime have enjoyed the tax deduction in the years that you made those contributions. Those contributions can be fairly significant, into the hundreds of thousands of dollars. So if you're one of those fortunate few that has a small business that's highly dependent on a specialized skill and you make a lot of money doing it, this is an option that you may consider looking at. For most other businesses that are in the small business category, if you have a dedicated space in your home, want to take a home office deduction, there may be some good cause to do that. The rules around home office deductions and the penalties associated with it in some cases have been relaxed considerably. And so it may make sense to investigate that again if you're using dedicated space in your home for office purposes. Lastly, income deferral or acceleration is a possibility. And with that, I'm going to bounce to our fourth poll question and launch that for a minute. So that seems to be the common sentiment. Everybody thinks that they're going to be higher than 2021. I personally do as well. So with that in mind, you need to think about whether or not you want to defer income to next year. And in fact, you may want to accelerate it into this year. And the time to think about that is probably now. If you want to get the income into 2021, the challenge will be to get bills for December and November out quickly, to progress bill as much as you can, as quickly as you can, so that that income comes in 2021. If you are of a mindset that rates are not going up, but it might be going down, and nobody on our call is, then deferral might be a better option, and letting it run to the future year. I'm not inclined to do that myself. The second, or the corollary to that, is accelerating your expenses or deferring them. And again, if you're looking at your tax bill this year and want to accomplish some savings, you can certainly accelerate your expenses. Certainly look at purchases of needed equipment that will benefit your organization longer term. Take advantage of bonus depreciation and Section 179 expense depreciation to take a deduction on your tax return that benefits this year's taxes. Other savings opportunities are to look at employee benefits that are excludable from the Social Security wage base, so that if you're giving employees an opportunity to acquire a benefit that they might find attractive. Insurance companies like Aflac offer a lot of discretionary insurance products. There are other things that you can allow your employees to take on a pre-tax basis. To the extent that they do, it lowers the Social Security wage base, saves on your employer payroll taxes. It's kind of late in the game to be doing that for this year, but it may be something you want to consider going forward. We do get a benefit this year. It was a nod to the restaurant industry, which was largely crippled by the pandemic. Meals this year are 100% deductible. So in your business spending, if you've entertained clients at a meal, that is 100% deductible if it meets the other rules for deductibility, business purpose, and those sorts of things that you've got it documented. Those meals will be 100% deductible. Entertainment is still not deductible, won't be deductible next year, but meals this year, we are getting a benefit, and that's something that should reduce taxes a little bit. The infrastructure bill, which is the one that is passed, eliminated the ERC credit. This was a substantial benefit to employers that retained their workforce during the pandemic. It extends through through September 30th of 2021. Then it gets eliminated. Again, if you haven't taken advantage of that, something to look at, because it does provide a fairly significant benefit. And the revisions to the rules made it somewhat easier to qualify for 2021 than it was for the fourth quarter of 2020. It also extended interest rate smoothing provisions for pension plans, which doesn't affect a whole lot of us unless you have a defined benefit pension plan. And it introduced reporting requirements for cryptocurrency. So it's certainly a signal that that's going to be a focus of tax efforts in the future. But for right now, they're just requiring that those who transact business in cryptocurrency report that information. So prospective changes for 2022 on the business side. On the good news side, it extends the research and experimentation expensing rules through 2025. So you get a more rapid write-off of your research and experimental costs than if you would have to capitalize them. There was considerable talk about increasing corporate tax rates. It doesn't look like that's happened in its entirety, though. They have introduced an alternative minimum tax for businesses, which also promises to be a reporting headache. There was talk about a three-tiered approach to corporate taxes with a lower threshold, the current tax level of 21%, and then a higher tax threshold for income over certain levels. That seems to have been abandoned in favor of leaving the corporate tax rate alone and providing a lower tax rate for income up to $400,000. It changes the business interest expense limitations. It's complex. In the words of one major national firm, a complex transition is likely. So again, another reporting headache, but there are business interest expense limitations on what you can deduct, and those rules are looking to become more complicated. It also is going to modify deduction limitations for remuneration in excess of $1 million. So if you are an executive that's drawn more than $1 million for your company, not all of that money will be deductible. And it aggregates that remuneration now from a controlled group. So if you spread that $1 million in compensation over 10 entities so that you can get it all, the aggregation rules are now going to eliminate the benefit of that. And it's also going to clarify the definition of remuneration so that more is includable in arriving at what is subject to tax and what is not available for deduction. Other changes, clarification of controlled group rules to include a lot of entities with common ownership or under common control. Previously, it was really a parent affiliate relationship, and now they're looking more broadly at common ownership as a whole. There will be deferral of losses in controlled group liquidations. So if I choose to liquidate my company, sell it to my related party, and they hold on to it at a higher basis and defer or recognize it, allow me to recognize a gain on the sale, then I'm not going to be able to recognize a loss on the sale. I'm not going to be able to take that loss right away. And a recognition that a lot of companies are rewarding their stockholders by boosting the price rather than paying dividends, which are taxable. And there's now going to be an excise tax on corporate stock repurchases to make sure that the tax man gets paid anytime shareholders enjoy a benefit. There are also going to be limitations on gain exclusions for small business stocks for high income taxpayers. And as I mentioned, the corporate alternative minimum tax based at 15% on some adjusted financial statement income. So if we report one number for financial statements and a much lower number for taxes, in all likelihood, we will have to pay some taxes based on some adjusted number of that financial statement income. Rules yet to be provided. And again, a nod to energy efficiency and green energy. There is an expansion of energy efficient commercial buildings deductions. There's a relaxed energy consumption threshold so that you don't have to meet as high a bar to qualify. There's a reduced offset period for prior deductions. So if you've already incurred some savings and credits for prior spending, the look back period has been more limited so that you may be able to get additional qualifying expenditures eligible for the credit. And then an alternative deduction for qualified retrofit. So it's not just new property, it's taking an existing property and meeting the qualified retrofit rules, to be eligible for a deduction. On the downside and likely to be more expensive, looks like we're going to have mandatory employer provided sick leave and retirement accounts at certain levels, not clear what those are yet. And also likely that there will be a federal family and medical paid leave program to take it out of the hands of the individual business owners and establish something at a federal level that will likely also be costly and administratively complex and more expensive over the long haul in terms of the tax bills that we all pay. And sorry for that editorializing, but it's nonpartisan because both parties have done their part in making sure that the tax bills go higher. So with that, I'll stop and take any questions that we have.
Everyone, you can feel free to add this into the Q&A pod or the chat pod if you have any questions for Kevin. He was able to cover a ton of ground, and I really like that this presentation was talking about, exactly what you can do right now, as well as what you could possibly be thinking about in the future, and looking at that from both an individual perspective as well as a business owner perspective. I know that a lot of the people who jump onto these calls are often small business owners, they have 1-person shops, 2-person shops, 5-person shops, and these things are really going to be a major difference maker when it comes to your business. So having the knowledge on your side and, tax planning can really help out a lot.
I'd just like to thank Mike for hosting this and appreciate the opportunity to present. Mike,
Sure. You're welcome.
We appreciate, so it's nice to give back by sharing as well. Thank you.
I did see a question from Diane. She asked, do you know if the $600 threshold was removed that allowed IRS to monitor all transactions on back accounts more than 600? I'm not quite sure what she's referring to.
I'm not either. $600 is a threshold for 1099 reporting.
There was also a charitable contribution threshold, isn't it? Wasn't
It
that-
is, but that $600 is, as long as you contribute $600, you can claim it. You really don't have to provide a lot of details. So I'm not sure how much monitoring could go on at that.
Anyone who had $600 activity on a bank account could be monitored, is what Diane is suggesting.
Yeah, I have not followed that one, so I can't answer that, unfortunately.
I will say that one of the things that anybody that, if you are a small business owner, or if you are assisting small business owners, are some of these rules relating to family leave and retirement plans and medical leave. These are issues that I think are going to be more frequent in the coming year or two. I just saw, at least in the city of Pittsburgh, that there's now a move afoot to prevent employers from discriminating or against employees who have to miss work as a result of domestic violence at home. If they have to miss time because of that. Those types, that umbrella of issues, where employers are going to have a broadened responsibility regarding time away from work from their employees, is going to continue expanding. And it really creates a complicated web of analysis and decision-making for employers, what to do, what questions to ask as relates to these employment matters. They're going to need to have somebody that they can get a hold of, whether it's a business consulting group like Donnelly-Boland or an attorney, to say, hey, this is what's going on. What do I do? Right? Because the lift for a small business owner to be aware of all of these new rules and regulations and what to do is pretty challenging. So it'd be better for them to only have to basically lift their phone and call somebody who knows this stuff and just say, hey, help me out with this because I don't want to get myself into a jam.
I think the challenge that we're seeing with lawmakers is we need to provide input as to constituents as to the cost of doing some of these things. We're paying more taxes. It's costing more to do business because of some of these rules and regulations that they're imposing, without regard to the cost of providing that particular control or benefit. It's not necessarily a reasonable trade-off.
Yeah, especially for business owners who are coming out of a pandemic and struggling a bit. They're also having to bear higher employment costs. And so it's kind of a chaotic time for small business owners to be imposing new things on them like that. It's tough. It's difficult right now. The challenges are significant out there for folks. So they're owning small businesses.
On here, it also has something about the Legal Shield Commission, including GSTs.
Let me see here. Do I? GST. Joanna, I don't know if she can unmute or you can clarify what that means. I'm not sure what that means.
While we're waiting on that, a couple people actually asked, will this recording be available afterward? And yes, it will be. So we work with Mike's team on getting that put together and ready, and we put it up on Mike's YouTube page, and that gets sent out to everybody later. So you'll have the opportunity to view this later. And it also seems like I got a couple private messages. A couple people ended up joining late because of some time zone things, and that's okay too. And that's one of the real benefits of being able to do this online, that you can go back and find this resource and say, wait a minute, what did he say about this? And then you could just scroll through and find exactly what you're looking for.
Yeah, I did include a link in the chat for anybody interested that Noel had covered the home business deduction in pretty good detail in our webinar from, I think it was last month, or might have been at the beginning of this month.
Yeah.
Time is going so fast, but she may have done that. And she really talked a lot about it and did a very good job on it. So I highly encourage you to take a look at that and look for that portion of the webinar to get some more information on that, because that probably applies to a lot of folks, especially these days, right? There are more gig workers out there that are stringing gigs together and working from home. And so that's become more relevant than ever.
And you could spend the whole session just on that and maximize that deduction.
Right. But one of the lessons to take from this, and I think I made this observation during Noel's last session, was having a relationship with an accountant is very important, because they can talk to you about things that you should be looking at prospectively, right? If you had a relationship with an accountant, they could tell you that all your meals are going to be deductible in the year, and you might change what you're doing in order to take advantage of that. And many of these other tax savings opportunities where you can sort of build that into your planning. So if you're doing your year-end budgeting, right? And I think Ray took us through a year-end budgeting webinar not that long ago. These are the types of things from a prospective standpoint that you need to be looking at and building into your plan for 2022, right? And take advantage of some of these things to the extent that you can. Every little bit helps, right?
Absolutely.
Yeah. I think oftentimes we hear the word tax loophole. They're not loopholes. They're literally written in the tax code so that you can reduce your taxable income for things. These are things that legislation has gone across and passed for us to utilize these things. And I think that the more that you know, and the more that you can reduce your taxable income, the better off that you can be in the long run. And these things really do add up.
Yeah, absolutely. And some of the little things that you can do to save taxes and benefit your employees at this time when it's so difficult and so critical to retain employees and differentiate yourself are really important for you to know. There's a benefit that can help you and help them, and also help you retain your folks. And you want to educate them too, right? Sometimes educating your employees is the most important thing that you can do. And if you work with a payroll service, sometimes they're able to put together sort of analyses of what your employees' real earnings are, right? And they may not really understand that for all of the things that you're doing for them. If you have an employment plan or a health savings account, or you offer them a deduction for their transportation expenses, they can pay for those without a tax-free deduction on their wages. Those types of things, you can put all of that stuff together. And you want to be educating your employees, or encouraging your small business customers to be educating their employees, because that's part of an employee retention strategy.
I know that when we started putting the employer share of benefits on our payroll remittance, biweekly remittance advices, people had a better appreciation what the total cost of their employment package was.
Yeah, and health insurance, the employer portion of the health insurance is a big dollar. And health insurance premiums never go down. They always go up. And employers are losing an opportunity for employee retention by not telling folks what they're actually doing for them.
Sure.
Yeah, so
Well,
a couple of takeaways there.
I want to thank everybody for being here. After this session, you're going to be getting something from Anna on our team from Donnelly-Boland. It's a really quick survey. It takes you about 2 minutes to fill out. And it says, what did you like? What didn't you like? What do you want to see in the future? And really that third portion is really what we're looking for. We haven't figured out exactly what our programming is going to be for next year. So if there are things that you want to hear about, please let us know. We are actively looking for, okay, well, should we be doing another seminar like this, or should we be trying something different? So have your voice heard. And also, if you thought that Kevin just did that most knockout of the park job in the world and you wanted to give us a Google review, we would, really appreciate that too. So we'll make sure to include that link. Thank you all for being here. You'll be hearing from us. And when you hear from us, you're also going to get that YouTube link so that you can go back and check out this video. And we look forward to partnering with Mike and his team more in the future.
Thanks, guys. Have
Thank
a
you
good
all.
one.
Take care.